Welcome to the Real Estate Experts Summit 2020 today. We have Paul Hakim as our next guest speaker. And Paul, I've known for a number of years, and we've inspected properties in different parts of the country. He's a very fun guy, but he's also president of Pioneer Capital, and he's president of Pioneer Advisors. Pioneer Advisors advises people on transactions, and Pioneer Capital is his arm for raising debt and equity financing for a number of different business situations, including non-real estate situations. And so Paul is a brilliant strategist, and I'm really grateful we have him. He's going to tell us what we're going to talk about on the summit that's coming up.
Okay, well, thank you for the glowing intro. We're going to talk about debt and equity formation today, as well as some other aspects of capital stack, and really concentrating on the after-tax world here, because that's really what matters to our investors, is the after-tax effects of their investment.
All right, awesome. So if you want to come to the summit, there's no charge for it, and you just go to realestateexpertssummit.com. Again, that's Real Estate Experts Summit, all one word, experts, realestateexpertssummit.com, and you can register to come to the summit and be on our program. So we'll look forward to seeing you there. Hi, this is Chuck Sutherland at the Real Estate Expert Summit 2020. Our guest this hour is Paul Hakim from New York State. And Paul is I've known him for a number of years. He is a brilliant strategist. He's a fun guy, but he puts together debt and equity transactions that are very complex and produce a ton of benefits for his investors and partners. And so Paul, welcome to the summit.
Great, thank you. And I need to clarify that I am in the real New York, upstate New York, not in the city.
Oh, that's right. The real New York. The rest, I've never been so surprised when I went to upstate New York and I saw how green it is, and you get the ski mountains, and it's like an amazing part of the state.
Right. As I travel around the country, I'm always amazed. People are like, what's it like to live in a big city? And population of our town's 25,000, next town's 20 miles away, and it's 15,000. So, but I can be in New York in under 2 hours in the middle of the city.
Oh, awesome. Well, I want to tell our viewers what we're going to cover this. We're going to talk a little bit about Paul's background in terms of the transactions he's put together. Paul is a member of the Society of Exchange Counselors. I know you've heard of that on this event. He's also a CCIM. That's a very coveted commercial investment designation from the National Association of Realtors. And he's also been very, very active in raising money for transactions and buying properties. So Paul, why don't we start with, what have you been doing in the last couple years in terms of raising money, and then pivot that to what are you doing now and in the future raising money in a total shift of the economy. So what have you been doing, and then what are you pivoting to for the future?
Well, you know, our pivot really hasn't been that abrupt or drastic. You know, we for some time have faced a real estate environment where good deals are hard to come by. So if you can find the deals, you know, good money will follow those deals. So, you know, the focus is really on acquisition and identifying those good deals, and the money will follow. You know, for many years, there's been a lot of pent up equity and demand for product. That still continues. You know, we're starting to see a little bit of a shift in people having more interest in land right now, because land is one of the best hedges on inflation. But you know, again, identifying the projects, packaging them right, putting the right team together to advance the project, you know, is crucial right now.
Oh, got it. And then what kind of say this last year or so, what kind of product, what kind of deals have you been focusing on in the environment that was after the Tax Reform Act? And
Okay.
then what is it? And let's talk about that first. What have you been? What type of deals have you been doing?
Well, so, I think the differentiation is, geography on the types of deals that we've been doing. We've had a lot of success in the southeastern states, working with multifamily developers, getting equity infusions into their deals because those markets are rapidly growing. The same with industrial in those states, as in addition to the central located states. Here in the Hudson Valley, again, we're 90 minutes north of New York City. We're 3 hours from Boston, and we're in a beautiful part of the world with the Catskill Mountains. And there's been a big drive here for the last almost 20 years to increase the tourism, and it has worked. So in the last 4 years, I worked on everything locally from a $780 million casino. I was on the capital team for that. With actually worked with CBRE's gaming finance division. I had no idea they even had something like that prior to that, but it's amazing what you come across in deals. But we've also had, I did a $25 million boutique hotel project, did a $35 million hospitality project. And on both of those projects, I did the debt and equity. And on one of those, we leveraged the Opportunity Zone program. We actually recapitalized and leveraged the Opportunity Zone program to recapitalize the $25 million hospitality project, which they were going in with about 70% in equity into the deal. We recapitalized the project using the Opportunity Zone dollars, giving the investors Opportunity Zone benefits. We pulled the cash and recapitalized that sponsor on that deal, and then he took the cash and put it into his other deal, which was not in an Opportunity Zone. So again, it's just identifying, programs that fit the geography and the asset types that work with the different geographies.
And for those of people that aren't familiar with the Opportunity Zone, could you explain that? Because I know you're highly trained, experienced.
Yeah, so yeah, the Opportunity Zone program was introduced as part of the 2017 tax changes. It is something that was discussed for many years, and I think through many administrations had discussed it, but in the 2017 Act, it was actually implemented. What that did is they were trying to force or incent investment into MSAs that needed the investment. So these were economically challenged areas. The Treasury Department tasked the governor of every state to come up with a list of these geographies within their state. In New York, I believe there was 88 different MSAs that were identified for this type of investment. The investment could be either directly into real estate or directly into those Main Street businesses, meaning I didn't need to buy the real estate. I could buy shares in the local hardware store or in the local restaurant. When I bought these shares, I got a twofold incentive. If I had purchased the shares prior to the end of last year, I would have been eligible to get 2 steps up in basis. A 10% step up in basis and a 5% step up in basis. Since we're past and we're into 2020, as long as we make the investment before the end of this year, we will only benefit from a 5% step up in basis. Meaning if I bought the property for $1 million, I could end up only having an $850,000 basis upon my disposition of the property. The step up in basis is beneficial. This is not like a 1031 exchange. You do end up paying the capital gains on the sale in the 2026 tax return. So it is a deferral of the capital gains tax that you're realizing either on a stock sale. So if you sell your Amazon stock or any other type of stock in the stock market, you would realize this step up in basis and the deferral of paying the capital gains till 2026. The downside of this, and again, this is to incent money to come out of the stock market and be invested into our main streets, either directly into real estate or into the businesses. If it wasn't a real estate transaction, you needed to double the basis on the property. So again, you go buy the $1 million property, you allocate 20% of that to land, so you have an $800,000 basis on the improvements on the property. You would need to spend at least $800,000 improving that property. So I sell a property, I defer the gain, I get a step up in basis on that gain, but I have to pay the tax in 2026. If I stay in that deal, so now we bought a new property for $1 million, we put 800,000 into it. Fast forward 10 years from the point that you put the asset into service, as long as it is sold before 2047, June of 2047, if that property in 2030 or 2035, for example, is all of a sudden worth 10 million, there is no capital gains on that gain in that investment. All right. So it is a little confusing, but it really is meant to stimulate and create a vast amount of wealth over a period of time.
Yeah, and what I hear you say is that you've got some immediate benefits with not paying taxes on what you've sold. If you're coming into it with something you've sold like real estate or stock, you don't pay taxes on that capital gain until 2026. Correct. And then if you stay in that property for 10 years, then you pay no tax on that sale after that 10-year period, as long as
of the replacement property. Yes, but I'll add to that one other caveat. I've done 6 of these transactions, and in every single transaction, I have advised my client to pay the capital gains tax immediately, not wait and defer till 2026. Right now, we've got probably the lowest capital gains rates that we've ever seen. And how many election cycles away is 2026, right? So we don't know what capital gains could be in 2026. So, I've told the people if they have the ability to make that tax payment, to pay that tax now, or pay it over a couple of years while the tax rate is favorable.
So that's what you've been doing, and I know the transactions you're working on are pretty significant transactions. Though in terms of the tax act, it doesn't have to be $1 million property or $250 million property. It could be a $50,000 property.
Exactly. One of the projects was $80,000 land acquisition, had a minor improvement on the property. It was like an old garage or something, and they were redeveloping that into a multifamily. That wasn't a distressed neighborhood. It was a large piece of property that was just derelict and sitting there and kind of like a little junkyard. We were afraid of environmental concerns because of all the garbage that was strewn around on the property. But it was clean, and now that $80,000 acquisition, they're making a $3.5 million improvement on the property. If they sit on that property for 10 years, they will have the ability to not have capital gains when they do finally dispose of the property. That's federal tax. Federal capital gains tax is what you are exempt from. Depending on what state you're in, you're still going to be subject to those state gains.
Yeah, which vary dramatically across the country. The state.
Yes, amazingly, yes. Yeah,
so dramatically.
It's like COVID restrictions.
Yeah. Now, in Texas, we don't have an income tax, so it's pretty much a moot point here. But then you get the full benefits. So, but the benefits of avoiding paying taxes, not evading, but reducing your tax bill can be really significant motivator for people to invest in opportunity zones.
Right. And, you know, for people and people in the media, especially who don't understand this, they're not loopholes. Okay. A loophole is something that's a gray area that you're trying to leverage.
Mm-hmm.
This is black and white. Okay. So these are valid deductions that people need to take advantage of and are very dramatic in the changes to people's pro forma and especially their after-tax internal rate of return upon disposition of the property.
Yeah, the total return includes that tax savings.
Well, you know, it's not what you make, it's what you keep.
Yeah.
Right?
Yeah.
Yeah.
And the Tax Act that enacted this was very intentional and very thought out and worked out in the Congress. It was a major change in what was possible with reduction of tax liabilities.
Yes. You know, and that Tax Act also gave us the, you know, bonus depreciation and the ability to do cost segregation studies and accelerate the depreciation of all of the 15-year assets or consumables on the property, blacktop, roof, HVAC, all of that is eligible for bonus depreciation. So instead of taking that straight line depreciation over 20 years or so, you're going to take that depreciation year one. You know, fast forward from that, they, in the CARES Act, and the CARES Act is what gave us the PPP program and some of this other extended unemployment benefits as the federal bailout, let's call it, for COVID related instances. What they did in the CARES Act, which was great, they did two things. They increased the amount of items that are eligible for cost segregation now that you can take bonus depreciation. If you have apartments, for example, that number went from about 25% of the total project cost to almost 37% of the total project cost. So for investors in multifamily, this was significant. Taking that one step further, the CARES Act also gave us the ability to file this special COVID form with the IRS. So typically when you get that bonus depreciation and that accelerated depreciation, it's a carry forward to apply to future years' taxes to offset and lessen that tax load. With the CARES Act, they were trying to get more money on the street and in people's hands sooner than later. So any properties that have been put in service since 2017 Tax Act are eligible for a refund when you do that cost seg. So now, you know, you do a $10 million apartment complex, you can almost give $3.5 million in accelerated depreciation back to your investors. And then if it's done before the end of this calendar year, in this fiscal year, you've got the ability to apply for a refund. I'll give you an example how we're applying that. I have a client locally. He was contemplating, and we were pretty close to pulling the trigger on an $18 million hospitality expansion, hotel rooms with a conference area. He's got about 60 rooms already and a spa and a restaurant, beautiful property on the river. So now he's tabled the large hospitality project for a lot of COVID reasons, but it's time for him to move forward with the spa expansion and renovation. That's about a $4 million project. So I'm working on his economic development incentives. I was reviewing his balance sheet and noticed that they have about $12 million worth of improvements on the property that have not been cost segged yet. So we've hired and retained a cost segregation engineer. They're coming into his hospitality project. We believe we're going to identify between 7 and 7.5 million of immediately depreciable assets on that project. He's in a 40+% tax bracket. So we are going to, we think that we're going to be able to apply for a refund and put cash in his bank account, totaling about $3.2 to $3.5 million of his $4 million project. So we might not even need a bank to do his $4 million renovation and expansion of his property.
That is amazing. And if anybody here that's on the summit doesn't have that big a property, this applies pretty much across the board to all kinds of properties. So if you bought property and you're doing renovation, particularly, you want to make sure you talk to your tax accountant about this, about all the tax benefits that have accrued over the last couple of years. We're now just, and we're continuing to see people save money doing that.
Yeah, we've got 6 cost seg studies going on in our own portfolio right now.
Yeah, amazing. Paul, so let's shift and look at what you're doing now, what the future holds in terms of what your plans are coming up, given that the market is shifting. So what are you engaged in now, and what do you see the future?
So about a year and a half ago, we started selling off our multifamily properties here in New York because they've been talking about New York City style rent control throughout New York State. Kind of mixed feelings on that because, there is a demand. We've got a lot of people moving out of the urban areas up into our environment. They're able to zoom in for work. We here in Kingston, New York, National Association of Realtors or Realtor.com reported Kingston, New York having the highest year-over-year growth of 18% in residential values. We were the highest nationally. That was in Bloomberg a couple months ago. And it's all COVID related. All these people, poor people in the city were stuck in, the 50th floor and 900 square feet. And mind you, that 900 square feet in New York City, probably sells for $2,000 a square foot. And then they come up here and, for $500,000, you can have, 4,000 square feet in your own little Idaho. So, we're starting to see a lot of attention coming up here. We have been focusing now on acquisitions in the South and in the central states. And my personal concentration has been on industrial properties, industrial, mixed use, and flex type space. My son, Nicholas, who he is aggressively pursuing the mobile home park space. They've actually got 5 parks under contract right now, and they acquired 2 last year. His premises, there was a report, I think it was in Forbes, about the average retiree only having about $22,000 in assets. So they're going to be relying on Social Security. So mobile home parks, and, don't take me wrong, mobile homes have just like modular homes. They're totally different than the stigma that you see around that. But, this is affordable home ownership. And that's what they're incenting, putting newer homes and renovated homes. And it's just a pad rent, but you own your home. So again, it's a path to home ownership for a lot of retirees, that really don't have the wherewithal to do too much more than that. Our concentration on industrial over the last year and a half, the timing probably could not have been better. We've been canvassing for at least 18 months. And now, with all the supply chain changes, industrial is hot right now. You see a huge spike in Amazon, all this home delivery type products. I never thought we would use something like Instacart, but we were using that, while we were quarantined, at that point. Supply chain is changing for everything, especially grocery. A key fact in that is in 2014 was the first year that eating out and dining out sales surpassed grocery store sales. Okay, so then come March and April, all the restaurants were closed. So that pendulum and that 60% of the people that ate out more, or the 60% more dollars that were spent eating out, were all of a sudden all concentrated on the grocery store. So not only were people shopping, but they were home, they had time, they were cooking all this fancy stuff. So, you think of your friends on Instagram or Facebook that you saw out there, everybody was cooking, right? So that's why we were starting to have trouble in the supply chain for the grocery stores, like toilet paper. During that, you couldn't find toilet paper anywhere. If you went to WB Mason or you call your, office supply company that supplies the office buildings and everything, they could have brought you tractor trailer loads of toilet paper. It wasn't the consumer brands, the Charmin, type products, but again, that shift in buying habits, translated very strongly into the need for industrial space. With the industrial space and the warehouse space, we've also going to see a lot of industries repatriate. So, manufacturers, it's amazing the tenants that we're fielding down in Greenville and Charlotte for industrial buildings down there. We're bringing manufacturing home, which is fantastic. We're losing our reliance on the international economy, but also the just-in-time delivery that Walmart prided itself on. Okay, that's all going to change because now they've realized the need to stockpile and have reserves for all of these products so that we have the ability to do it. An interesting statistic, for every $1 billion of increase in online sales, whether it's food, Amazon, generic stuff, that equates to 1.2 million square feet of warehouse space that's needed, high bay warehouse space. And you see all this space going up all over the place. It's phenomenal how quickly it's going up, and also how quickly they're filling and backfilling these properties. So I think I answered part of your question.
Yeah, that's awesome. And the long-term implications of all this seem to be pretty significant. Like Florida, as an example, is developing into a hub in the northern part of the state, in the Tampa, Orlando area. But there's Dallas-Fort Worth is exactly the same way. We're just crazy booming with industrial space and new distribution space, and new production space. It's so did you see that trend? You see that trend continuing over the long term?
Yes, I do. And we're not doing those 500,000 and million square feet tilt wall buildings that you see going up everywhere. That's a whole nother level and a whole nother league. You've got a lot of institutional money chasing those deals. They're happy with 5.5 and 6 cap deals. Where we're finding the sweet spot ourselves is in that class, B- or C property in close proximity to those buildings. Okay, so we're in contract on a 170,000 square foot building outside of Chicago. It's near an inland port. It's a C grade property, but it's well located. It's got canal access for barge. It's got rail access, and what was phenomenal, we were talking to the broker and we're flying over on Google Maps looking at it, and he goes, no, there's 5 million square feet of new space within 3 miles of that building. He goes, you just can't see it on Google Maps yet. And we're like, wait a minute, it's only a 2-year difference in the map. And we went out there, and not only is all that space there's another couple million square feet under construction. And the space that is built already is full. Amazon's in almost 1.7 million square feet. You got Target up there. There's Tractor Supply. So again, it's a good spoken hub area. But now we've got the 170,000 square foot C grade property in that area. This is where all the suppliers are. You need box companies. You need the shipping companies need a place to store containers, put trucks in overnight, lay down lots, those types of services, for those types of buildings, for those larger distribution type companies. So, and that's, the companies that service the conveyor belts to, all those needed flex space service type industries that are around those big boxes. So that's where we're concentrating on, because our price point isn't $80 a square foot. Our price point's $20 to $30 a square foot. Yeah, we've got some CapEx to do and some repositioning, but we're finding a lot of opportunities. And for us, it's easier to raise money on a $7 million deal with $2 million in CapEx than going to raise money on a $50 million, tilt wall project.
Yeah. So there's a lot of money flowing to these kind of deals, right?
Yes, there are. I know we spoke earlier about a little bit of a paradigm shift. Some of the things that we're doing are a little more speculative. We're buying buildings that are dark or will be going dark, as opposed to buying something that is stabilized. Okay, so we're somewhat forfeiting immediate cash flow and immediate returns for that long-term benefit and that long-term appreciation. So, a lot of syndicators and a lot of people are out there raising money on they're talking about an 8% preferred return, which is great if there's a return, right? But then, they do an 8% prep and then, maybe 50-50 on the equity or the upside beyond that, right? So what we're doing is we're focusing and taking a little bit more of a private equity approach. We're taking a management fee along the way, all right? We are sometimes not paying a pref or paying a smaller pref, okay? Because it's all about the upside, not about the immediate cash flow. So again, different types of investors looking for different types of properties. You need a little bit of both in your portfolio, right? So you've got a lot of investors who are going to rely on the income and need the cash flow, but we are going to give them multiples of that in the upside, because we're going to create more upside, but that means there's a dry period up front.
So the preferred return, sorry, if there is a preferred return on the front end, will be lower.
Yes.
In some deals, but with higher long-term gain.
Well, we structured one where the 7% preferred return ramped up as we brought occupancy in the building, because everybody's going in eyes wide open, this building's dark. So if I'm promising you an 8% pref and I don't perform, what typically happens is that gets added to your capital account. So if you're a $100,000 investor, I don't meet the 8% pref, that bumps your capital account up to 108,000, and then you start earning 8% on 108,000. At a certain point, you're eating my lunch, right? Because I already forecasted to you that it's going to be a 3 years to stabilization. So the investor needs to keep me hungry also, so that I'm willing to perform. We all need to eat along the way, but it boils down to return at the end of the game. But as you get a lot of real estate people that go bankrupt because they're not making money along the way. It's all about the upside, right? So I know there's a lot of people in New York City who are caught in that trap right now, because not only in New York City are the numbers crazy, but they do crazy things on real estate acquisitions. So they'll go in with a 3-year interest only on a 2 cap deal, okay? So, it's all about the upside. Now that the music has slowed down in New York City, there's a lot of people flapping in the breeze that are paying interest only, and actually the asset's going to be worth less money. Some friends of my son's in New York City renegotiated their lease. They were like on a waiting list to get into this building a year ago. They have a 3-bedroom. They rented, it was $5,600 a month for a 3-bedroom apartment. Their lease came up last month. They renegotiated at $4,100. Okay, so that's significant. And to the real estate investor, that's your NOI. if there was NOI, now it's gone because, we don't operate on those types of margins.
Right. That was the difference between those rates is your income that you're going to get off of that property.
Yep. There's no free cash flow, right? But, and somebody could have bought that building a couple years ago on interest only. There's going to be some lenders out there that are going to be owning a lot of real estate right now. It's not the time to be making those types of investments in those urban areas.
Let's look at a different area now. So if you were advising somebody new or relatively new that they've invested in some properties and now they're looking to expand and deal with the future, but they're not in the size of deals you're working on, what would you advise them to focus on in the next 2 or 3 years if they're smaller investors?
There's a lot of Main Street opportunities that are overlooked. I'm doing a couple transactions right now with a couple large family offices, and your institutional and those family office type investors and your higher net worth people, they're looking at ease of the investment. So they want to do asset management, right? They just want to see what their return on their capital is. They don't want to know anything. So there is a lot of opportunity in the, smaller properties. So, but you need to understand that, at a certain point, if you don't have or can't afford management, you're buying yourself a job, right? I've got a doctor friend and we ran into him and, this was probably like December last year. And he was like, "Oh, we bought an investment property." I said, "Oh, what'd you buy?" He goes, "A 4-family. And I just kind of grinned. I was like, "Well, who's managing it for you?" He goes, "Oh, good. There's management in place." He goes, "No, my wife's going to manage it." And, they had no grasp of the fact that they bought themselves a job, because even though his wife was going to be running it, they're not accustomed to getting no hot water phone calls or no heat calls in the middle of the night, or my garbage isn't picked up, or this neighbor, chasing this guy for rent. Okay. And, if you're not accustomed to that type of stuff, it's a hard thing to do to call somebody and shake them down for, $800 worth of rent that month.
Mm-hmm.
It also takes a lot of time. So for people that are resigned and are eyes wide open, that know what they're getting themselves into, there is a lot of opportunity in those stepping stone type properties. The other thing is there's a lot of partnership availability and there's a lot of investors out there. People will wonder, why can't I, how am I going to do this? I don't have money. I've only got 10 grand or 20 grand. Find a friend. Everybody's got a 401k or an IRA. Educate yourself on the self-directed IRA. There's a new website out there I found really cool, and it was not cumbersome at all. It was rocketdollar.com. Not a commercial. Everybody go do your own due diligence and everything, but I've got a couple clients who are using it now. And what was cool was as you did a rollover and opened up your IRA account with them, they simultaneously set up an LLC for you, and they married the operating agreement for the LLC with their compliance. Okay. So you have the ability to open an account with them, and I opened one myself. I haven't done anything with it yet. It was $1,000 to set up, and I did a $2,000 rollover from my conventional plan that's sitting in there. So now I've got an account open with an LLC, and I have the checkbook. So if I go find an opportunity and I want to go do a rollover later of $50,000 into that and write a $50,000 investment check into Chuck Sutherland's next deal, I can do that without a lot of compliance headaches. Because again, I have an account open. I can just do a simple rollover to that and then write Chuck a check.
And the company's handling all the compliance management.
Exactly. Typically, it gets a little cumbersome with your transfer agent or custodian that's handling those retirement accounts. They were like, "Oh, I want to review Chuck's operating agreement. I want to review Chuck's pro forma, right? And they want to vet the deal, and I want to vet the deal. I made the investment decision, and I want to be able to just write the check and go into that at will instead of having to wait for somebody in compliance to second guess my investment decision.
Yeah, even if it's not your, like, for the smaller investors, even if it's not all your money that's going into it, a lot of other people who are just itching to get into a good real estate transaction. The question is, good real estate transaction is the key word there.
And you mentioned earlier, we're members of the Society of Exchange Counselors. It's a national real estate group. It's amazing the amount of local groups that are out there. I've been moderating, since the COVID shutdown. I helped bring the SEC virtual, and we've been doing virtual national marketing sessions. But now we've got the New York State Commercial Association of Realtors. Every other week we're having meetings. I'm moderating the Kentucky Real Estate Exchangers meetings every Thursday. We're dropping in on the Denver Mile High Real Estate Group. I was just having Greenville last week, and Jason Dillard had the Greenville group going. And the Greenville group was great. And all of these real estate groups, don't be intimidated, because people are there to share, right? We're looking for deals, and I go on to all these calls, and it's like, hey, you're a broker. If you see something you like and say, God, I wish I could own that, call me. We'll find a way, right? So,
Yeah, there's similar groups all across the western part of the country too. And you go out to California. There's one in Orange County, the Orange County Group, San Diego, the National Council of Exchangers. There's real estate investing and marketing groups all across the country.
And all these people are willing to share. They've got capital. They're looking, to put money behind deals. If you're not as experienced and you found a deal, you might not have control of that deal, but you know what? You can be part of the deal, and then you can get hooked up and be in a deal with some really smart people that can help bring you to the next level, and you learn along the way.
Yeah, and there's some really, really, really sharp people all across the country, and they're willing to, they're willing to focus on the people as well as the property in order to find ways to make real estate transactions. So it's a great place to go to learn how to do transactions that aren't just the fork over retail price and pay all the cash and own the property. You can make all kinds of deals.
And real estate people don't really understand or boil it down to the fact that we are in the people business. We trade sticks and bricks, okay? But it's the people that create the value, whether it's the people that are formed to do the syndication or the people that are going to occupy the piece of real estate that are going to create the value, right? So it's all relationships, and it's all tied together. There's usually, when there's a dark building, it's an ownership problem. Is 9 times out of 10 is what the issue is with the piece of real estate. There's no such thing as a bad piece of real estate. Okay, it's just poor timing of ownership. At any given time, there's somebody looking to land bank, there's somebody looking to renovate a building, and at the same time, there's somebody that's looking to get out of a stabilized building because they don't want to manage it anymore. So there's opportunities at every level. It's just finding the people, creating relationships with the people, and getting in the game.
Paul, thank you for being with us. It's really amazing what's happening in the different sectors of the real estate market. And, we hear about, multifamily a lot, but we don't really get a peek behind normally the motivations of investors. And you really have laid that out for people.
Yeah. Well, we've had a couple blips here, the Great Recession, the, .com collapse. Okay. But I think that this, for the real estate investors, is the Super Bowl. Okay. There is going to be the largest transfer of wealth that we will see in our lifetimes. as a result of this. Pay attention, and at the end of the day, it's not about what you make, it's about what you keep. So be smart about it.
Awesome. Well, Paul, thanks for coming. I really appreciate it, because I know that you're out there doing rather than talking about doing, and it's really great for people at the summit there to hear it from you.
Well, thanks for having me.
All right. Thank you.